At 3:17 a.m. on Tuesday morning, my phone buzzed with a price alert I never expected to see. Silver had just crossed below $20. I sat up in bed, grabbed my phone, and stared at the screen thinking it must be a glitch. It wasn't. At 11:47 p.m., Monday night, silver was trading at $31.84. By 3:17 a.m. Tuesday, it had crashed to 1972, a 38% collapse in less than 4 hours. By the time markets opened in New York, silver was at 1943, the lowest price since March 2020, the largest single-week decline since the Hunt brothers collapse in 1980. Financial news was running apocalyptic headlines. Silver bubble bursts. Precious metals in freefall. Is this the end of the silver trade? My phone was exploding with messages from friends, family, and viewers of this channel asking the same question. What are you doing? Are you selling? Is it over? I'm going to tell you exactly what I did. Hour by hour. Decision by decision. The panic I felt. The discipline I forced. The actions I took. And why, 7 days later, I believe this crash was the greatest buying opportunity of my lifetime. This is the full story of the worst week in silver in 45 years, and exactly how I navigated it. Let me set the scene because context matters. Before the crash, I held approximately 200 ounces of physical silver with an average cost basis of $26.47 per ounce. Total invested, approximately $84,700. At 31 to 84 pre-crash, my position was worth approximately $101,188. I was sitting on unrealized gains of approximately $17,188, or 20.3%. I also held positions in 3 silver mining stocks totaling approximately $47,000 at pre-crash prices, and I had $12,400 in cash specifically allocated for precious metals purchases, sitting in a money market account waiting for a buying opportunity. That's where I stood when my phone buzzed at 3:17 a.m. Hour 1, the panic. I won't pretend I was calm. I wasn't. My heart was pounding. My hands were shaking. I pulled up multiple price feeds to confirm what I was seeing. Kitco, COMEX live ticker, TradingView. They all showed the same thing. Silver in freefall. I watched the price tick lower in real time. 1968, 1954, 1947, 1931. It felt like watching a car crash in slow motion. Every tick was money disappearing. My 200 ounces that were worth $101,288 4 hours earlier were now worth $61,792. I had lost $40,096 in unrealized value while I was sleeping. $40,000. Gone. In the time between when I went to bed and when my phone woke me up. My mining stocks, which I couldn't check until market open, were certainly going to be worse. Miners amplify moves. If silver was down 38%, the miners would be down 50%, 60%, maybe more. I did the rough math in my head. My total precious metals position had probably lost $70,000 or more overnight. The urge to do something was overwhelming. My brain was screaming at me to act, to sell, to stop the bleeding, to protect what was left before silver went to $15, $10, $5. Every instinct I had was telling me to panic. I didn't sell, not because I'm some superhuman investor with nerves of steel, because I had prepared for this moment, because I had rehearsed it mentally 100 times, because I had written down, months ago, exactly what I would do if silver crashed 30% or more in a short period, and I had promised myself I would follow that plan no matter how I felt in the moment. This is the first lesson. You cannot make good decisions in a crisis if you haven't made them in advance. The plan I had written said 3 things. 1. Do not sell physical silver in the first 72 hours of any crash. 2. Assess the cause of the crash before taking action. 3. If the cause is technical or liquidity-driven rather than fundamental, buy aggressively. I pulled out that written plan at 3:30 a.m. and read it 3 times. It calmed me down. It gave me a script to follow. It took the decision-making out of the emotional moment and anchored me to logic I had developed when I was calm. Hour 2 through 6. Understanding what happened. Instead of selling, I spent the next 4 hours researching. What caused this crash? Was it fundamental or technical? Was the thesis broken, or was this a temporary dislocation? Here's what I found. The trigger was a massive liquidation event in the futures market. According to preliminary data that emerged over the following days, a major commodity trading advisor, a CTA, had been forced to liquidate approximately 47,000 COMEX silver contracts, representing 235 million ounces of paper silver, in a span of less than 3 hours. The CTA had been running a leveraged long position in silver as part of a trend-following strategy. When silver broke below a key technical level at $29.50, their risk management systems triggered automatic selling. The selling pushed the price lower, which triggered more selling from other algorithmic traders, which pushed the price lower still. A cascade, a liquidation spiral. A technical event driven by leverage and automation, not by any change in the fundamental supply and demand picture. The physical market told a different story than the paper market. While the COMEX was in freefall, the Shanghai Gold Exchange barely moved. The overnight session in Shanghai showed silver declining only 4%, not 38%. The divergence was extreme and telling. Shanghai, which requires physical delivery, saw modest selling. COMEX, which is 95% paper, saw apocalyptic selling. This was not a physical silver crisis. This was a paper silver crisis, a crisis of leverage, a crisis of algorithms, a crisis that had nothing to do with industrial demand, investment demand, or the actual availability of metal. The thesis was intact. The manipulation was on full display, and the price was giving me an opportunity that might not come again. Hour 7 to 12. The plan takes shape. By 9 a.m. Eastern, I had calmed down enough to think strategically. Here's what I decided. First, I would not sell any physical silver, not 1 ounce. The physical silver in my safe had not changed. It was still 3,200 ounces. It would still be 3,200 ounces tomorrow, next month, and next year. The paper price was an abstraction, a fiction, a number on a screen that would normalize once the liquidation event exhausted itself. Selling physical at paper crash prices would be the worst possible trade. I would be converting real metal into dollars at the exact moment when the metal was most undervalued relative to its true worth. Second, I would deploy my $12,400 cash reserve immediately. This was money I had specifically set aside for buying opportunities. This was the buying opportunity. If I didn't buy now, when would I ever buy? At $32? At $35? The whole point of keeping cash on the sideline was for moments exactly like this. Third, I would assess my mining stocks at market open and potentially add to positions if the selling was overdone. Miners were going to be destroyed in the open, but miner crashes often overcorrect and snap back quickly when the underlying commodity stabilizes. Hour 13 to 20, execution. At 9:30 a.m., the U.S. markets opened. My mining stocks were down between 52% and 67% at the open. First Majestic, my largest position, opened at 147, down 64% from Friday's close of 4.08. It felt like a gut punch even though I expected it. The unrealized loss across my 3 minor positions was approximately $29,000. Combined with the silver loss, I was down approximately $69,000 from my Friday valuations. In one weekend, one liquidation event, one algorithmic cascade, I took a deep breath and started buying. My first purchase was physical silver. I called SD Bullion at 9:45 a.m. The phone rang for 11 minutes before anyone answered. When I finally got through, the representative sounded exhausted. He said they had been fielding calls since 4 a.m. Half the calls were panic sellers trying to liquidate. Half were aggressive buyers trying to acquire. The premiums had exploded. Before the crash, generic rounds were $2.50 over spot. During the crash, they jumped to $7 over spot. Even at $19.43 spot, the actual purchase price for generic rounds was $26.43. The physical market was not pricing silver at $19. The physical market was pricing silver at $26 or higher. This confirmed my thesis. The paper crash was not reflecting physical reality. Dealers knew the paper price was a fiction. They were maintaining premiums that reflected true scarcity. I placed an order for 200 generic rounds at $26.43 each. Total, 5,286. The representative told me delivery would be delayed 3 to 4 weeks due to overwhelming demand. I didn't care. I wanted the metal, not fast shipping. I placed a second order for 4 100-ounce bars at $2,087 each, representing a premium of approximately $144 per ounce above the spot price at the time of order. Total, 8,348. Combined physical silver purchased, 13,634, representing approximately 600 ounces. I had exceeded my $12,400 cash reserve by 1,234, which I covered from checking. My second set of purchases was mining stocks. At 10:15 a.m., I logged into my brokerage account and surveyed the damage. First Majestic was trading at $1.52, down 63%. Hecla was at $2.14, down 58%. Pan American was at 8.76, down 52%. The carnage was severe but not surprising. I had a decision to make: add to positions or cut losses. The fundamentals of these companies had not changed overnight. Their ore reserves were the same. Their production capacity was the same. Their cost structures were the same. What had changed was the silver price temporarily due to a paper market liquidation. If silver recovered to $28 to $30 within the next few months, as I expected, these miners would double or triple from crash levels. I added to all 3 positions. I bought 500 additional shares of First Majestic at $154, cost $770. I bought 300 additional shares of Hecla at $218, cost $654. I bought 50 additional shares of Pan American at $882, cost $441. Total mining stock purchases, $1,865. I funded this from my regular brokerage cash, not from the precious metals allocation. Day 2, the bounce begins. By Wednesday morning, the liquidation appeared to be exhausting itself. Silver had stabilized around $20.50 overnight. The Shanghai premium had widened to $8 over Western spot, indicating intense physical demand from the east. Industrial users were stepping in. The smart money was buying. The weak hands had been shaken out. At 8:30 a.m., Eastern silver started climbing. 20.74, 21.18, 21.56, 22.03. By noon, silver was at 23.47, up 20% from the Tuesday low. My phone was buzzing again, but this time with messages asking, should I buy now? Did I miss it? I didn't respond to most of them. I was watching. The mining stocks were recovering even faster. First Majestic was at 2.41, up 59% from Tuesday's low. Hecla was at 3.08, up 44%. The leverage was working in reverse. The same amplification that had crushed the miners on the way down was now rocketing them on the way up. Day 3 to 5. Continued recovery and second thoughts. By Friday, silver was back to $26.84. The crash that had taken silver from $31.84 to $19.43 had now recovered to $26.84. From the low, silver was up 38%. My physical silver position, 3,200 plus 600 new ounces totaling 3,800 ounces, was now worth approximately $101,992. I was roughly back to my pre-crash valuation, but with 600 more ounces. The 600 ounces I had purchased at the crash price represented a cost of $13,634. At $26.84, those ounces were worth $16,104. I had made $2,470 in unrealized gains in 3 days on the new purchases. The mining stocks had recovered approximately 60% of their losses. I was still underwater on the crash, but far less than Tuesday. The positions I had added during the crash were up between 40% and 65%. I took time on Friday evening to process what had happened, to extract lessons, to document what I did right and what I could have done better. Here's what I concluded. Lesson 1. The plan saved me. If I hadn't written down my crisis plan in advance, I would have sold. I'm certain of it. At 3:17 a.m., watching $40,000 evaporate, every fiber of my being wanted to stop the pain. The only thing that stopped me was the piece of paper that said, "Do not sell in the first 72 hours." I didn't trust my in-the-moment judgment. I trusted my pre-committed plan. This is the single most important lesson from the entire experience. You must make your crisis decisions before the crisis. Write them down. Make them specific. If silver drops more than 30%, I will not sell any physical for 72 hours. I will research the cause. I will deploy cash reserves if the crash is technical rather than fundamental. Whatever your plan is, write it down now, today, before the next crash. Because in the moment, you will not be rational. You will be emotional. And emotion is how you lose. Lesson 2. Cash reserves are crucial. I had $12,400 sitting in cash specifically allocated for precious metals buying opportunities. That cash had been earning 4.8% in a money market account for 6 months, waiting. Some people called that inefficient. Some people said I should be fully invested at all times. Those people were wrong. The cash reserve allowed me to buy 600 ounces at crash prices. Those 600 ounces will be worth $60,000 at $100 silver, $90,000 at $150 silver, $120,000 at $200 silver. The opportunity cost of holding cash for 6 months was approximately $300 in foregone returns. The opportunity captured by deploying that cash at the crash was potentially $100,000 or more in future gains. Keep cash reserves. Always. The opportunity will come, and when it comes, you need ammunition. Lesson 3. Physical premiums tell the truth. During the crash, the spot price said $19.43. The physical market said $26.43. The premium expanded from $2.50 to $7 precisely because dealers knew the spot price was a temporary fiction. They weren't going to sell their inventory at a price that didn't reflect reality. They widened premiums to capture the true market clearing price. This is why I always say, the premium is the real price. In normal times, premiums tell you about supply conditions. In crisis times, premiums tell you about the divergence between paper and physical. A $7 premium at $19 spot is the market screaming that $19 is fake, that $26 is real. Listen to the premiums. They don't lie. Lesson 4. The thesis matters more than the price. At no point during the crash did the fundamental case for silver change. The industrial deficit was still 200+ million ounces per year. The COMEX inventory was still draining. The Shanghai premiums were still elevated. The central banks were still buying gold. The dollar was still being debased. The reasons I owned silver were unchanged. The only thing that changed was the paper price, temporarily, due to a leverage-driven liquidation event that had nothing to do with the physical market. Understanding this allowed me to see the crash for what it was, an opportunity, not a crisis. If your thesis is sound, price drops are gifts. They let you acquire more of the asset you believe in at lower prices. If your thesis is not sound, you shouldn't own the asset regardless of price. Know your thesis, trust your thesis. And when the price drops, ask yourself, has anything changed in my thesis? If the answer is no, buy more. If the answer is yes, sell. It really is that simple. The hard part is doing it when your hands are shaking. Lesson 5. Mining stocks require even more discipline. My miners dropped 52 to 67% in a day. That is a test that most investors fail. The instinct is to sell the miners first because they feel more volatile, more dangerous, more likely to go to zero than physical metal. But this instinct is wrong, at least for quality miners with real production and real reserves. The miners that survived the crash, that didn't go bankrupt, that kept operating through the chaos, will emerge on the other side with the same assets and dramatically higher margins when silver recovers. The leverage that crushed them on the way down will rocket them on the way up. First Majestic at $154 is the same company as First Majestic at $4.08. Same mines, same production, same management. The difference is the market's temporary opinion of silver's value. My job is not to trade the market's opinion. My job is to own assets that will be valuable when the market's opinion normalizes. The 500 shares I bought at $154 could be worth $15 to $20 per share at $100 silver. That's a 10x from crash levels. The discipline to buy when everyone is selling is what creates generational returns. Lesson 6. Communication matters. During the crash, I received over 400 messages across various platforms, friends, family, viewers, all asking what to do. I couldn't respond to most of them in real time, but afterward, I realized the importance of having shared my thesis and strategy in advance. The people who had watched my previous videos, who understood why I owned silver, who knew my crisis plan, they weren't panicking. They were buying alongside me. The people who were panicking were mostly those who had bought silver without understanding the thesis, without a plan, without mental preparation for volatility. Communication before the crisis creates allies during the crisis. If you have family members who own silver, talk to them now about what to do in a crash. Make sure they understand the thesis. Make sure they have a plan. Don't let the next crash catch them unprepared and emotional. What I would do differently. Looking back, there are a few things I could have optimized. First, I should have had more cash reserves. $12,400 let me buy 600 ounces, but I could have bought 2,000 ounces at crash prices if I had $40,000 in reserves. The opportunity was bigger than my ammunition. I'm increasing my cash reserve target from 10% to 20% of my precious metals allocation going forward. Second, I should have had limit orders in place for the miners. The crash happened overnight and pre-market. By the time I was buying at market open, the stocks had already bounced 5–10% from their absolute lows. If I had standing limit orders at prices I considered attractive, say First Majestic at 125, I might have captured even better entries during the pre-market chaos. Third, I should have been more systematic about documenting my purchases in real time. I was scrambling during the buying phase and my record keeping was sloppy. I've since reconstructed everything, but it would have been easier to document as I went. The aftermath and where we stand now. 1 week after the crash, silver is trading at 28.47s, not fully recovered to the 31.84 pre-crash level, but 46% above the 1943 low. My physical position of 3,800 ounces is worth approximately 108,186 irons. My mining stocks have recovered approximately 70% of their crash losses. The new positions I added during the crash are up significantly, and most importantly, I have 600 more ounces than I would have had if I had panicked and sold or simply frozen and done nothing. The crash was painful. The fear was real. The temptation to sell was overwhelming, but the plan held, the thesis held, the discipline held, and I came out the other side with more silver, better positioned mining stocks, and the confidence that I can survive whatever the market throws at me next. Here's what I want you to take from this video. Crashes happen, they will happen again. The next one might be 20%, it might be 40%, it might be 50%. The paper market is leveraged, manipulated, and prone to cascading liquidations that have nothing to do with physical reality. You cannot prevent crashes, but you can prepare for them. Write your plan now, build your cash reserves now, understand your thesis now, document your holdings now, mentally rehearse the scenario now, so that when your phone buzzes at 3:17 a.m. with a price alert that makes your stomach drop, you have a script to follow. You have decisions already made. You have discipline preloaded. And instead of panicking and selling at the bottom, you do what the smart money does. You buy. Aggressively. Systematically. While everyone else is running for the exits. Silver crashed 38% last week. I didn't sell a single ounce. I bought 600 more. And I believe those 600 ounces will be worth more than everything I owned before the crash by the time this cycle is over. The crash wasn't a disaster. It was a gift. The only question is whether you had the preparation to receive it. This is John Cashflow. Silver crashed. I bought. Now you know exactly how and why. Make your plan before the next one, and I'll see you in the next one.